Hello, it's a very lovely good evening once again from here in Delhi, and hope as always that each one of you are happy, in fine spirits, and of course in fine health. So now, after this tagline, honestly speaking, now each one of you have become quite acquainted to this. But anyway, let's come to the business end now. Actually, so far in this particular chapter, we have completed section 1, and I hope that after having gone through section 1, you must have realized that actually realize the quality of teaching, in the sense that you must have realized actually how we go about regarding the topic, and some of the student might be feeling bit bored in the last session. Reason being is that it could be a possibility that they might have done the questions themselves, but still actually I do not want to take the risk. That's the reason actually I have a habit of solving each and every question. But anyway, now in this particular session, as I told you, after having completed the first session, wherein actually we discussed at great length regarding NCI, goodwill, and of course gain on bargain purchase. Under first topic, actually, you must not neglect the what we call last few minutes of last session. I mean to say, the previous session, wherein I framed some MCQs and asked you to actually answer the same. It is very important when you go through each and every section, you have to visualize what sort of MCQs could be tossed up out of that. So, when we studied the first session, over there, 2-3 important points which you need to keep into your mind: that entity has got the option to value NCI either at fair value or what we call at proportionate method basis. Very important to note that when NCI is valued on fair value basis, in that case, goodwill which appears in the consolidated financial statement will reflect the group's share. Whereas when NCI is measured on proportionate basis, in that particular case, the goodwill which appears in the consolidated financial statement, it is reflective of only the acquired shares. Correct? The parent share, you may say so. So now, after having done up with the first topic, and I hope you must have enjoyed those feedbacks I am receiving, but still I would love to have some more feedbacks. I want flurry of what we call feedback, so that one can really judge and one can assess that what sort of coaching we are offering, and others also might get tempted and they may actually also, like you, go through these sessions. Now we are moving over to section 2. Over here we are going to cover the most heaviest part of this particular chapter. Correct? This topic is related to demergers or sale of division or split offs. These are some new terminologies for most of you, but very soon, after 2-3 seconds, you will come to know the meanings of all these things. And due to demerger, sale of division, or split offs, we will have to study this term, common control. Now, regarding common control, India 103 actually has given some guideline in its appendix, which is appendix C, in fact. So, appendix C actually talks about common control and how the acquirer would do the accounting. Correct? How the acquirer and acquiree would do the accounting in case of common control. That we are going to take that into account. First of all, these are the terms which are not easy to understand, to be very honest with you. And second important point regarding this particular topic is that it is quite complex, you may say so, but I will make it extremely easy and almost like a cup of coffee for you. Don't worry about that. That's an assurance from my side. But why I am still saying that it's quite complex in the sense, because if you were to actually scan the modules of different what we call professional bodies, you too would wonder, like me actually, that same question has been solved in a particular module in a different manner, in a particular module of a particular institute. I do not want to name them, but in a different manner. So that is where the problem actually arises. Now the problem is that we have to teach to the students of what we call every professional body. That's the point. So that is the reason. Good thing is that we are giving separate what we call courses for separate institute. So good thing about is that. So anyway, so whatever procedure your module is adopting, we are going to adopt that. But at the same time, where we would find that this particular treatment which your institute has done, when we will see that it is definitely not in tune with the guideline of the standard, then only I will talk about that. Correct? But I will simply not ask you to follow, in that case, my guideline. You may still follow the institute's guideline. I will explain both the guidelines. So you need not require to worry on that particular count. But anyway, now let's first begin actually what we mean by common control, what we mean by demerger, sale of division, split off, etc. I told you these are the These are quite tough terminologies. So in order to understand and grasp the meaning, let me pick up first of all the scale. Now please pick up your scale, pen, pencil and start writing with me. I'm coming directly to the point. I'm explaining all these terms with the help of this diagram. First of all, I presume there is an organization, correct? So I draw a square for you. My drawing is not very good. So let us say it's a very big enterprise or big organization. Correct? This is big organization. We further presume that this organization has got two divisions. Correct? Organization, and this organization has two divisions. This organization has two divisions. Let us say division A for simplicity and division B. We further presume for a while, let us say division A deals with a particular product and division B deals with a particular product. You can presume any product. Let us say division A deals with cosmetic products, whereas division B, let us say, deals with computer accessories. Correct? Anyway, it has got two divisions. In fact, I will draw it this way so that you understand it better. This organization, I told you, has got two divisions. These are the two divisions which I am drawing for your understanding sake this way around. These are the two divisions, correct? Division A and division B. You will understand the meaning and later on you will be able to do the accounting. Remember one thing, this area is always considered very dreaded by the students and almost everybody. You understand actually what I want to say. Okay, now these are the two divisions of this particular enterprise or organization of company, whatever you may call it. In between, allow me to take what we call sip of this tea. Actually, classes are running since morning, so I'm quite tired also. But intensity will not be less, don't worry about that. Some lighting issues are there. Let me actually just adjust the lightings. Okay. So division A and division B. Now, I presume that due to some or other reasons, company, this organization or company or entity decides to dispose this division. Entity decides to sell this division, correct? Let us say this division B is sold to another company. Division B sold to new company. This division is sold, company decided, let us say division B is operating under losses. So this enterprise thinks that it is better to dispose it off, it is better to sell it off. So they sold it off to a new company. Let us say this is the new company. This is the new company, correct? And this entity has sold the division B to a new company, which I just told you. This is your new company. We further presume that name of new company is C. So division B is sold to a new company or another company. This is the situation so far. Now try to understand actually the point I'm trying to make you understand. Suppose, what diagram should I draw? Okay, let us say it's a tree, correct? I have already told you my drawing is not very good. We further presume that it's a mango tree. It's a mango tree, not apple tree. I do not know actually how a mango tree looks like, but anyway, it's a mango tree. I presume that on this tree, at this particular moment, there are only 5 mangoes. Mango 1, mango 2, mango 3, mango 4 and mango 5. There are 5 mangoes at this particular moment which are stuck up on this particular tree. Now let us say suddenly wind blows fast, correct? And let us say out of these five mangoes, one of the mango falls down. Let us say fifth mango falls down. So if I am going to ask you a very simple question, after the fifth mango has plucked out of this tree, how many mangoes are there in the tree? So 4 mangoes, obviously, because one mango is lying here now. This is one mango which has fallen down. Now I am going to ask you a very simple question. Could you tell me what this tree will be now known as? Sir, it will still be known as mango tree. It cannot be apple tree. You are absolutely right. It will remain mango tree. But the point is, in accounting jargon, I will call it demerged entity. Now it is demerged entity. Its size has become, actually size hasn't become less, but just for the sake of saying, allow me to say so, that, or let me tell, its eminence has fallen down. Earlier it was having 5 mangoes, but now it is having only 4 mangoes. So that is why it is called demerger, because generally when two things merge, the size becomes wide and big. But here it is a case of demerger, correct? So out of 4 mangoes, 1 mango has fallen down. I will call it now, it is a demerged tree, because some part of this tree has plucked out. Is it clear to you or not? Now try to understand here. The analogy through this example which I want to draw with this example is that here the earlier organization was having 2 divisions, correct? Now since one division has been sold out, now you let me know what I should call this division, or in accounting terminology or in business terminology. Now this organization, after the sale of division B, will be known as demerged entity. Demerged enterprise or demerged entity. It will now be called as demerged entity. You got my point or not? It will be known as demerged entity. This organization, after sale of division of B to a new company, because it is now left up with only one division now, so that is the reason it will be known as demerged entity. I hope you got the meaning of demerged entity. Now this process, what is the process? The process is that we have sold out division B to a new company. This process is known as demerger. This process shall be called demerger. Because when I am selling one division to some other company or to a new company, so this process is known as demerger of the enterprise. Is it clear to you or not? This process is also can be termed as sale of division. I told you earlier, I will explain the meaning, so I hope now you are getting it. It is also known as sale of division, because one division is sold out to some other entity. Is it clear to you or not? Quite obviously, out of these 2 divisions, one division has moved out or one division is plugged out. So this process is also known as split off. S-P-L-I-T. It is also known as split off. Is it clear to you? So you must understand that demerger, sale of division or split off are generally actually one and same thing, or synonyms. Is it clear to you? So now you should not let skip out of your memory what we mean by demerged entity. Demerged entity basically means the main entity and one of its division has gone out. So that is why it will be now known as demerged entity. Now, after familiarizing ourselves with the terminology, the next part is, when this division will be sold to this particular company or to a new company, whatever it is, quite obviously, who is selling this division? Obviously, this is the main organization. So main organization is selling the division to the new company. Are you getting my point or not? Yes, sir. Are we going to sell our division free of cost, or are we going to actually charge something from the new company? Quite obviously, new entity, new company is the purchasing entity. It is going to give us some consideration. Otherwise, why the hell in the world we are going to sell? Unless and until we are not going to receive anything against the same, isn't it? So, new company will definitely deliver some purchase consideration, and here some problem arises if we are not familiar with nitty and gritty of this concept. So please pay attention and don't let anything move out of your attention. Now, new entity is going to deliver the purchase consideration. Important point is that new company, there are two situations could arise. New company may give the consideration either to the demerged entity, the main organization, or it could give the consideration to the members of this organization. To the members of this organization. There is a difference between organization and members. Members means shareholders of this organization. Presuming new company has given the purchase consideration. This is your purchase consideration. Purchase consideration. If new company has given purchase consideration to the demerged entity, if purchase consideration is received by the demerged entity, that means new company may give the purchase consideration directly to the main organization, to this entity. Correct? One possibility is this, that new company may deliver the purchase consideration to the organization itself. And there is second possibility also. Second possibility is that new company may deliver the purchase consideration. This is otherwise a very tough part. But once you will understand all these things, then later on you will thank me that how easy it has become. But first, let us acquaint ourselves with some basics. This organization, let us say, is having shareholders. Quite obviously, if there is organization, there is entity, there is company, it will have shareholders. Shareholders are also known as members, as you know. Shareholders or members of demerged entity. Demerged entity. Shareholders of demerged entity. Correct? This organization is having some members or shareholders. So one possibility is that during the entire process, the new company may deliver the purchase consideration directly to the demerged entity, and there is another possibility that it may deliver the purchase consideration, PC, purchase consideration, to the members of the demerged entity. New company might give the purchase consideration to the organization. This is one possibility. Second possibility is that new company may deliver the purchase consideration to the shareholders or to the members of the demerged entity. Is it clear to you or not? Now, what repercussion it will have as far as accounting will be concerned? Because your accounting will depend a lot whether the consideration has been received by the demerged entity or the consideration has been received by the members of the demerged entity. That is very important to understand. Correct? Now you must understand one thing, which is of paramount importance. If new company will deliver the purchase consideration directly, if purchase consideration will be received directly by the demerged entity, then it will be known as a case of common control. If purchase consideration will be given directly to the demerged entity, in that case, it will be termed as common control. Then it will be termed as common control. Correct? Just allow me a second. Just allow me a second. Hello. Uh, uh, नहीं नहीं ये जो बच्चा है ये किसका नंबर है? अच्छा अच्छा ठीक 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 really sorry. So sometime it happens. Actually, I tell you, lots of work is going on because these are very vital times, and we have to take care of interest of all the parties. So that's the reason. Really sorry. I was coming to a very important point. So if the purchase consideration will be delivered directly to the organization, in that case, it will be called as common control. It will become a case of common control. What we mean by common control? Directly or indirectly means, if we will look very carefully, both these two divisions were earlier in the control of this particular entity. Are you getting my point or not? Now, because this entity has been sold to a new company, but new company has given this purchase consideration, and purchase consideration, as you know, is generally given in the form of shares. So, new company directly or indirectly has given the purchase consideration, let us say in the form of shares, to this entity. So, it means this entity is also exercising the control over this particular entity. Please pay attention this way around. This entity was earlier controlling these two entities without any iota of doubt. But now this entity has been sold, so its existence is over. This particular entity is sold to a new entity, but this new entity is still in our control. That means if we are going to see very carefully and if we can read between the lines, in that case we can easily infer that it is, as we call in English, status quo position. That means what earlier was the position is still after the sale or division the position is. Isn't it or not? So directly or indirectly we may say common control. The concept of common control comes into play only. The concept of common control comes into play only when actually the new company will still remain in our control. This division is in our control, needless to add that, but if new company still remains in our control, then definitely it will be a case of common control. Now another important point. If it is a case of common control, you remember in the initial stages we talked about the guidelines of the Ind AS 103. Now Ind AS 103 prescribes acquisition method of accounting. Are you getting my, do you remember it? Under the acquisition method, actually what we do, we recognize all the assets and liabilities at fair value, although there are some exceptions. Besides, we have to recognize the goodwill, we have to recognize the NCI, we have to actually recognize the gain on bargain purchase, etc. But here, in case of common control, again this case is under Ind AS 103, but this time it will be termed as a case of common control, and under Ind AS 3, under the Appendix 6, some guidelines have been given with respect to common control. So this time, the problem is that if the division is sold to a new entity and new entity delivers the consideration to the demerged entity, in that case it will become a case of common control, and in that case the important point is acquisition method will not apply, rather we will see pooling interest method will apply. Pooling interest method will apply. Pooling interest, what this exactly is that I am going to explain later on, but pooling interest method of accounting will be applied for the purpose of accounting. That is the reason why we need to have a look over these two concepts very carefully. Whether the purchase consideration is being delivered to the demerged entity or whether the purchase consideration is being given to the members. Now we take the another situation. Now suppose this entity is sold. this division is sold to this entity, and this entity now, instead of giving the purchase consideration directly to the demerged entity, decides to give the consideration to the members of the demerged entity. Sometime it may happen. Now if purchase consideration will be delivered to, the members of demerged entity, again do not jump over the conclusion. So in this case, acquisition method will come into play. Don't jump over to this particular conclusion. This is the biggest mistake, and in fact, it is nothing sort of a crime, should I say that way around. So before jumping over to the conclusion, you need to make yourself acquainted with all the provisions. That is why I am telling that slow and steady wins the race. Try to understand. If purchase consideration is given to the shareholders, in that case, two situations again may arise. Two types of situation we may face again. One situation is if new company delivers the purchase consideration to the demerged entity. In that case, it is quite simple. It will be a case of common control. However, if the purchase consideration, as I said, is given to the members, in that case, two type of situation we may have to confront, or should I say, we need to be in the know of those two situations to do the proper accounting. One situation A is one of the shareholder or one of the member holds more than 50% stakes in new company. If new company will deliver the purchase consideration to the shareholders of demerged entity, if new company will give the purchase consideration to the shareholders or the members of the demerged entity, and one of the shareholder holds 50% stakes in the new company, then again it will be a case of common control. You need to understand this. Again, it will be considered as case of common control because in that case also this entity will remain in the control or remain under the control of this organization, because purchase consideration is received by the members of this entity. They are already the shareholders of this particular entity, and if one of the shareholders is exercising more than 50% control of this enterprise, so quite obviously that means this enterprise is still being controlled by this enterprise. So that is the reason again it will be a case of common control. That means if the new company is still in our control, the case of common control will prevail. So that is the reason again we will call it a case of common control, and again pooling interest method will apply. Acquisition method will not apply. Pooling interest method of accounting shall apply. Pooling interest method. What is pooling interest method? I will talk about it later. If purchasing company delivers purchase consideration to the members of the shareholder, then there is second possibility. Second possibility is none of the shareholder, none of the members holds more than 50% stakes in new company. Try to pay attention. If purchasing company or the new company delivers purchase consideration to the members of the demerged entity, and none of the shareholder this time is having more than 50% stakes in the new company, so this time we may say this new company is not under the full-fledged control of this particular organization. Are you getting my point or not? Because in order to have the control, we need to have more than 50% stakes in this particular company. So if none of the shareholder is having 50% control in it, in that case, It will not be a case of common control. In this case, we may say acquisition method shall apply. In that case, it will be considered a real business combination, and in that particular case, we will call it, in fact, we will use acquisition method of accounting, which is prescribed by Ind AS 103. Is it clear to you or not? Is it clear to you or not what we have actually spoken of so far? So first of all, you need to understand the meaning of demerged entity. You must not forget it, because so many times I will let you know, I will ask you to pass the entries in the books of demerged entity. If you are not in the know of the real meaning of the demerged entity, you will not be able to understand. Second, when this particular division is sold to a new entity, two broad what we call situations may arise. One, the new company may give the purchase consideration to the demerged entity. In that case, no problem arises, and we can safely presume that it is a case of common control. And of course, as far as accounting will be concerned, we will have to adopt the pooling interest method. However, when the new company delivers the purchase consideration to the members of the demerged entity, in that case, we have to be careful. Because if the consideration is received by the members of the demerged entity, we will also have to see whether any shareholder is having 50% stakes in the new company or not. If the shareholder is having more than 50% stakes in the new company, then again it will be a case of common control. However, if none of the shareholder is having more than 50% control, that means new company is not under our control. Control is a very wide term, as you know. Control generally accrues when we have more than 50% stakes in that entity. So in that case, control will not be there, and acquisition method shall come into play. Is it clear to you or not? Now, when we say pooling interest or acquisition, the basic difference is that under pooling interest, we will have to use the book value, and generally the concept of goodwill will not arise. Although in your module, still the word goodwill somewhere is written, and honestly speaking, I fully do not subscribe to that view. Anyway, we'll talk about the module, we'll talk about our view too while doing the questions, don't worry about that. However, as far as acquisition method is concerned, we will have to take into account what we call fair values, and here the concept of goodwill definitely will arise. So that is the situation here. Correct? After having gone through these two things, now the next step is, which is quite vital, we come over to the accounting part. Now suppose, continuing with the same example, let us say this division has been sold to a new entity, and new entity, let us say, provides purchase consideration to the demerged entity, then it will become a case of common control. So first we are picking up common control. So I will write here concept of common control. Accounting under common control. Accounting under common control. Accounting under common control. First of all, what we will have to do, A, in the books of demerged entity, in the books of demerged entity, in the books of demerged entity, now you know the meaning of demerged entity, that is the enterprise, and one part of that particular enterprise has moved out. Is it clear to you? That is why it is a demerged entity. For example, the main organization. First of all, we will have to pass the what we call entries in its books. Just to make the point a little bit more clear, let me pick up rough sheets. Let us say this is the organization having two divisions A and B. This division is sold to a new company, and the name of the new company is C. A new company, we are presuming, has given purchase consideration to the demerged entity. Correct? Now in the books of demerged entity, we will have have to pass the entry. And there is no hard and fast rule. You can easily presume yourself as if you are the demerged entity. Earlier you were having the two division. Now one division has moved out. When I say this division has been sold, what does it mean? That means all of its assets and liabilities have been now delivered to the other enterprise. It is as simple as that. So first of all, you are going to pass this particular entry with respect to derecognition of assets and liabilities of this division, because now the assets and liabilities of this division will move out to this particular company. So that is the reason why you are going to actually derecognize the same. Secondly, don't forget that when this division is being sold, this demerged entity is receiving some purchase consideration. You are supposed to receive some consideration also. So keeping into account all these things, you will have to pass the entry. Now, first of all, what I am going to write in the books of demerged entity, my first entry will be for transfer of assets and liabilities. When we say our division is being sold, indirectly it means we are transferring all the assets and liabilities of that particular division. But that division is part of our organization, so we are going to note that. No doubt about that, we are going to do the accounting, isn't it or not? So, first of all, I will debit new company account. Why I am debiting new company account? The reason being is that I will have to take some amount from them, known as consideration. So that means this amount is due from new company because they are taking, that particular company is taking over our assets and liabilities. Now, whatever assets which the new company has taken over, I will have to derecognize the same. You let me know the natural balance of the assets. The natural balance of the asset is debit balance. At this level, it doesn't look nice to ask such question, isn't it or not? So now I have to derecognize the same. So I'm going to credit the assets, and likewise all those liabilities which will move out, quite obviously now I'm going to debit the liability. So I will write here liabilities. When I'm saying here liabilities, it means all such liabilities of the division which has been sold out. So you are going to debit the liabilities. Then you are going to write, intentionally I have left this line, to assets account. So all those assets which have been taken over by the new entity. Are you getting my point or not? Now it could be a possibility that there may be some balancing figure, correct? If the balancing figure will be towards the debit side, you will write it as follows. You will write it this way around. Loss on sale, you can write this way, loss on sale or loss on reconstruction account, R/C, reconstruction account. If there is loss, it will be a balancing figure. In case if the balancing figure arises towards this side. However, if the balancing figure is over here, in that case, you will write profit on sale. What you will write? Profit on sale. Profit on sale. Or you can write profit on reconstruction, because this entire process of merger, demerger, split off, reverse, all these are part and parcel of reconstruction activity, isn't it or not? Or reorganization activity as we call it. So this will be your first entry, but just you need not require to cram unless and until you are not going to think on logical lines, correct? Just by going through this pro forma entry, a feeling should arise in your mind that you are well capable of now facing the question. That is the motive behind actually writing all these things. Now you are presuming you are the accountant of demerged entity and one of your division is disposed of. So all the liability and assets of that division will be derecognized. There could be a balance. There could be either loss or it could be a profit. Quite obviously, next entry will be transfer of profit. Presuming there is profit on sale. If there is profit on sale, that profit will be transferred. Please pay attention. Will be transferred to what? Profit on sale or reconstruction account. Profit on sale or reconstruction account debit. We will transfer it to capital reserve. We will transfer it to capital reserve because it is a sort of capital profits, because this profit is arising because of sale of assets and liability and not because of what we call sale of business products. Are you getting my point or not? If somebody asks you why it is a capital profit, you should be in a position to deliver concrete what we call answer. However, if there is loss, obviously now you are going to set off this loss also. You cannot what we call allow this loss to stay as it is. We will have to write it off. So for writing of loss, for writing of loss on sale, if there is loss on sale, you can write it against capital reserve if there is balance in capital reserve, or you can write it off against general reserve if there is any balance, or you can write it off against profit and loss account if there is a balance in profit and loss account. Are you getting my point or not? To loss on sale. To loss on sale. This is how you are going to actually pass the entry. Now, quite obviously, the third part is 1, 2, 3. Now the third part is with respect to consideration. Third part is with respect to consideration. As I told you, as far as consideration is concerned, it is a case of common control. But case of common control could arise when purchase consideration is received by the demerged entity, as I talked earlier, or when it is received by members of the demerged entity, but one of the shareholder holds more than 50% stakes in the purchasing company. Try to pay attention over here. I told you, if purchasing company gives purchase consideration directly to this entity, it will be a case of common control, no doubt. However, common control could arise here also when new company will give the purchase consideration to the members, and one of the member holds 50% stakes, more than 50% stakes in the new company. So even in that case, it could be a case of common control. So when we will pass the entry for consideration, first of all, I will have to look, because we are doing the accounting under common control. Now, common control could arise when purchase consideration is directly received by the demerged entity, or when it is received by the what we call members of the demerged entity, but one of the what we call member is what we call having more than 50% stakes in the new company. So consideration, two situations may arise. If consideration has been received by the members of demerged entity, Now suppose purchasing company has given the purchase consideration to the members of demerged entity. In that case, what entry? Demerged entity will pass. See, there is a difference between demerged entity and members of demerged entity. First of all, try to have a look over the wordings. Demerged entity is something else. Members of demerged entity means the shareholders of the demerged entity. Now, if the consideration is received, suppose I am the demerged entity, correct? Now, purchasing company, presuming, hasn't given the purchase consideration to me, it has given the purchase consideration to our shareholders. If the purchase consideration is received by the shareholders, then logically I should not write any entry in that regard. Logically, I should not write any entry in that particular regard because I am not receiving anything. The consideration is being received by the members. But problem is that we have already written over here new company account debit. That means new company is our debtor company and we are supposed to receive something from new company. But the problem is that new company actually is not going to pay to us. They are going to pay to our shareholders. There's a difference between these two things. Of course, shareholders in their own personal books, they may write. That's a different matter. We are not concerned with that. We are concerned with the what we call books of demerged entity. So demerged entity, what it will write, pay attention here, and most of the students and many others do not know the exact entry. Capital reserve account debit. Capital reserve account debit to new company account. You might be wondering, sir, what is this entry? New company account. I am the demerged entity and I have to receive something from new company because I have shown them new company as a debtor. Because we have to receive something. New company now is being credited because new company, let us say, has given the purchase consideration to the shareholder. So now new company will no more remain as debtor. So I will have to credit him. But unfortunately, whatever they paid was not received by us. It was received by our shareholder. In fact, directly or indirectly, what I am trying to say is that I am crediting new company, but at the same time, I am not receiving anything against the same. So that is why it is a loss. I should never ever write here goodwill, and many books are doing this mistake. It is not goodwill. Of course, capital reserve debit means capital loss, no doubt about it. Goodwill also means capital loss, but we have to reflect it as capital reserve. Correct? It is a loss to us, and this loss has arisen because of this entire process of sale, transfer of sale of assets and liabilities. So that is why it is of capital nature. We are going to debit it to capital reserve account. Is it clear to you or not? Because we are not receiving any what we call consideration in actual terms. So that is the reason that new company is credited, but we are not receiving anything from the new company. What is being paid by new company is received by the shareholders. So that is the reason actually I am going to put up here capital reserve. Is it clear to you or not? Right. So if this is the situation, however, there could be another situation. As far as consideration is concerned, consideration could be paid to the members of the demerged entity or could be paid to the demerged entity. Situation B, if consideration has been received by demerged entity. Now suppose the purchase consideration has been received by the demerged entity. Now you are the demerged entity and you are receiving the consideration. So you are going to write here, generally the consideration will be in the form of shares. So shares in new company you are receiving. Shares in new company account debit to new company account. So if you will receive, in that case, no problem. Whatever you are going to receive, cash or shares, you are going to debit, and you are receiving it from new company, you are going to credit it. This is how you are going to pass the entries. Remember one thing. You are the demerged entity. All these entries which you have passed are in respect of the division which has been sold out. Now one division has moved out. So whatever is remaining with you at this moment, it will be known as the position after the demerger of this particular unit. Is it clear to you or not? What my point is, actually after passing these entries, question may ask you to prepare the balance sheet of the demerged entity. Second step. This was step number A. Okay, I will write second step. Balance sheet of demerged entity. Now you will have to prepare the balance sheet. Demerged entity, your entity became demerged because of sale of one division. Just to cite the point how the balance sheet is prepared, that is very easy, honestly speaking. Suppose this is the organization, correct? Having two divisions. Let us say property, plant and equipment of division A is 100, of division B is 500. So total is equal to 600. Now this division is sold out, let us say. Now if I am going to ask you, what is the position of this organization? This organization, first of all, after the sale of this division will be termed as demerged entity. Now this is the demerged entity and property, plant and equipment will be equal to 100. That means we are not going to write whatever earlier belonged to B Limited. That means whatever is remaining, that will be put in the new balance sheet. It is as simple as that. So preparation of balance sheet of the demerged entity is the most easiest task, provided we understand the real meaning of it. Correct? Now the next step is, of course, entries in the books of the new company. The new company is the acquirer company. Remember one thing, because it has acquired the what we call your division, and of course its balance sheet. We will see to it that, but give us 4 or 5 minutes, and after that I will continue the class. Correct? So till then you go through these ads. A very big sorry once again. Actually, some friends of mine had come to meet me, and sometimes you cannot simply say no. I hope you would understand actually. And so now, so far we have discussed regarding the common control, and regarding the common control we were discussing the entry accounting aspects, and we have seen that first of all in the demerged entity how the entries will be done and how the balance sheet will be prepared. It is not a very difficult task. When we'll pick up the question you will understand it fully, don't worry. But I have given you an idea actually. Whatever remaining assets will be there, and only suppose earlier there were two divisions, now there is only one division, so we have to put up the assets of that division and liabilities of that division. That's all. It is so simple. So the third step now deals with entries in the books of new company. Remember one thing, new company is the purchasing company. New company means the purchasing company. I am refraining from calling it acquirer company. Reason being is that here it is a case of common control. In case of common control, Appendix C of Ind AS 103 applies, and which doesn't refer to it as acquirer entity, rather it refers to as a purchasing entity. Correct? So that is the reason actually I am refraining myself from using the word acquirer, although for the sake of simple understanding you may call it acquirer company. Now you presume yourself as the new company. Now you have taken some assets and liabilities. So whatever assets you have taken, you are going to record it, you are going to debit it. Whatever liabilities you have assumed it, you are going to credit it. Besides the amount of consideration which you are supposed to pay to the other entity, you are going to credit it. It is as simple as that, correct? So there is no problem in this case. First of all, your first entry will be for taking over assets and liabilities. For taking over assets and liabilities. For taking over assets and liabilities, correct? So you will write here assets account debit. Assets account debit. Intentionally I am leaving one line. Two liabilities taken over. Two consideration which you are supposed to pay. See, from your side, because you are the paying entity, purchasing entity, you are supposed to pay the consideration. Here you need not require to worry whether you are supposed to pay to the demerged entity or to the members of the entity, because you have to pay the consideration. Correct? So assets account debit, liabilities and consideration. If there is a balancing figure, here I am deviating from module, but at the same time I am talking what module states. Your module has stated that if the balancing figure will appear towards the debit side, because sometime what happens is student attempt the question from the module and they let us know later on, sir, you have written here something else, and in the module it is written goodwill. Because most of us actually are under the impression that if consideration is more than net assets acquired, quite obviously it is a goodwill, because so far we have studied that. But don't forget, here we are talking about pooling interest method. Under pooling interest method, Appendix C of Ind AS 103 very clearly states that no new assets should be recognized. No new assets should be recognized. So it is better, rather than writing goodwill, you write here capital reserve itself, because it is a capital loss. Although even if you are going to write here goodwill, it is not going to make any difference. Honestly speaking, in the net answer, there will not be any difference. If balancing figure will arise over here, you will write capital reserve, but I have already told you, your module has here written goodwill. But I am not subscribing to that view. In my view, it should be capital reserve only, and moreover, this is also the view of other professional bodies. Correct? Because it is clearly stated that no new asset should be recognized. If I am going to write here goodwill, it means I am recognizing a new asset, and that is against the, what we call guidelines of the Ind AS 103 Appendix C. Further, Appendix C also states that all the assets and liabilities must be recorded at book values only. So all the assets and liability, we are going to record it at book value only. Correct? And if balancing figure appears towards here, I will write capital reserve, no doubt about that. That means whether there is debit balance or credit balance, in whether there is loss or gain, we are going to debit or credit capital reserve. Is it clear to you or not? However, debit capital reserve means goodwill only, it means capital loss only, but we cannot write goodwill. Logically, we should not write goodwill, because it is the guideline of Ind AS 3, Appendix C, that no new asset should be recognized. Secondly, very important, under common control, consideration which the purchasing company will record in its book will be at nominal value. What does it mean? And this is very important criteria. Suppose purchasing company has decided to issue 10,000 shares of rupees 10 each at the rate or at a premium of 15, let us say. So logically, premium will be 10,000 into 10 plus 15, because 10 is the face value and one share is carrying a premium of 15. So logically, purchase consideration is 2,50,000. Logically, it is 2,50,000. But it is clearly mentioned that consideration will be recorded at nominal value. That actually standard says that securities premium will be recorded at nominal value. What does it mean? Honestly speaking, no interpretation has so far given in any what we call original text of the standards. I've gone through almost every test, but nowhere I have come across the interpretation of this particular line in a manner which satisfies all of us. What my point is, if purchasing company, if it will be given to you in the question this way, that purchasing company will offer 10,000 into 10,000 shares of 10 each, which will be issued at rupees 15 per share premium. So logically, the amount of purchase consideration should be 2,50,000. When you will pass the entries in the books of the demerged entity, you will consider the purchase consideration at 2,50,000 also. But in the books of purchasing companies, since it is written very clearly under Appendix C that security premium will be recognized at nominal value, what does it indirectly means? Indirectly, it means now instead of writing premium or amount of consideration as 2,50,000, you will simply write 10,000 into 10. That is equal to 1 lakh. Sir, are we not going to record premium at all? Yes, you are not going to record premium at all under common control in the books of purchasing company because of the guideline. Number one. But then, sir, how the accounting of security premium will be done? If you will look carefully, suppose if I am going to write here the full amount, what will happen? The debit balance either will increase or the capital or the credit balance or capital reserve will increase. So whether here I'm writing the full amount or simply the nominal value of the shares, honestly speaking, it is not going to make any difference in the overall solution. But just to meet the guidelines, we have to go by that. Here, again, actually, suppose there are two examination bodies. I don't want to name just to avoid the controversy, to be honest with you. One body has written the full amount, to be very honest with you, while another body has taken only the nominal value. However, I agree with the body which is considering only the nominal value of the shares, because logically this line indirectly means that security premium should be recorded at nominal value. Indirectly, what does it mean? That you will adjust it along with capital reserve or goodwill, because I told you, even if I am going to write the full amount, either a full amount of consideration, say 2,50,000 instead of 1 lakh, then either it will increase the figure of what we call this capital reserve debit balance, or it will what we call decrease the figure of capital reserve credit balance. So automatically that amount will get adjusted. So it is not a big problem whether you write the full amount or simply the nominal, but my advice is to follow what is given in your module. So we will take into account only the nominal value. In your module, only nominal value is given. We will go by that only, not because it is given in the module, because I feel that this is the better and appropriate treatment. However, I am deviating from the treatment adopted by the module. Module here has written goodwill for the debit balance, which I do not subscribe to the view simply because of the fact that another guideline of India's 3 Appendix C states that no new asset should be recognized. Is it clear to you or not? So this is the point. Now second one is, of course, now I will write here consideration. Regarding consideration, this entity has to pay the amount of consideration. So here we have written consideration. I will write here consideration account debit. That means discharge of consideration it is. Consideration account debit to share capital account. Suppose we are presuming that consideration is being paid by way of issue of shares. Suppose if consideration is paid besides share capital cash also, I will write 2 cash, 2 preference share, 2 debenture, whatever may be the form of consideration, you are going to write it here. So this is how we have to go by. Although I know that each one of you are very keen and curious that I should do a question now, but it will definitely increase the time limit which we have set in, and it is important for us to set the time limit because we have to take the other sessions also. It also means that next session you should not miss at any cost. Over there we are going to pick up the questions, and I have uploaded, or I will upload, in fact, tomorrow you can download from my Telegram channel also the questions which I am going to do in the next session, and the first question which I am going to pick up, that itself is from your module, correct, regarding this. And we hope to, because these are very long questions, then 2.3, so common control questions, all these notes will be uploaded and you can download it, so in case if you want to. So next session I will be meeting with you. I am sorry that I took 2 interruptions today, but you also understand actually that sometimes it is not possible to say no to the colleagues and the friends who sometimes come to meet you, especially after a long time. So anyway, on such note, we take leave of you. Hope you must have enjoyed this session. Looking forward to have your feedbacks. It is very, very bad that no one among you actually gives the feedback. Only some of the students are giving us, although I feel very happy those who are giving and thankful to them, but still I would love to have what we call feedback from each and everyone. So on such note, we take leave of you. Shall be meeting you day after tomorrow most probably. So till then it's time to say good night. Stay happy.